From New York City for viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, America's top bond salesman unveiling a plan to double buybacks of longer-dated debt, but markets are not buying the short-term fix. Yields bouncing back to pre-announcement highs today, with Wall Street demanding more compensation for uncertainty around stubborn inflation, fiscal deficits, and supply pressure. And investors looking to the next big test for the bond market, Fed Chair Kevin Warsh gearing up for his debut at Jackson Hole in just 1 week. We begin with the big issue, losing control of the long end of the yield curve.
When the bond market speaks, people listen.
There are just too many competing factors out there that are moving long yields.
It's meaningful when the yield curve steepens, when rates are at this high of level.
It's a lot harder to appeal to market yields when the Treasury Secretary is actively intervening in that marketplace.
I'd be a seller. I'll give you that much. You know, we think there is a risk here.
The Fed has kind of been served a bit of bond humble pie here.
The pressure is on for Warsh to say something more.
The Fed's got to establish credibility and get a hold of the long end of the market.
What is uncertain is if Warsh cares about the long end as well.
There could be some sort of action designed to try and get those yields back.
What I will say is it begs the question, what problem are we trying to solve by adjusting policy preemptively?
You got to take some policy action here, I think, either on the deficit side or on the monetary policy side in order to make sure that we don't get too high of yields.
And that brings us to our chart of the week, the roller coaster ride that is the U.S. long bond yield since Monday morning. The 30-year yield peaked at 5.33% on Tuesday. That is the high since 2007. Then came Treasury Secretary Scott Bessent's surprise announcement on Wednesday. That was to increase buybacks of longer-dated debt. That led to a higher price, which means lower yields. And there you see the leg down. But it was short-lived and has now basically been unwound. And that's because the sell-off in the long bond is not something that just happened this week, this month, or this year. It goes back to the depths of the pandemic, right around here, with yields steadily rising over the last 5 years and at a much faster trajectory, too. And notably, it is a global phenomenon. The U.S. long bond yield is the blue line here, and yields in Japan, the U.K., Germany, those are the other colored lines. They have also been climbing as well. Long maturity bonds are at the epicenter of a bunch of different market anxieties, but all related. Persistent inflation, government spending, geopolitics, and now the AI debt boom. And on top of that, you have Fed credibility in question. With Bessent now intervening in the bond market, San Francisco Fed President Mary Daly is doubling down on the central bank's mandate.
The Treasury Secretary is different than the Fed. The Fed is talking about price stability and full employment. And what I do know, and we've historically been able to do this, is that we have a goal and we can achieve those goals through our policy implementation. And we will find a way to do the job that Congress gave us, which is restore inflation to 2% as our goal as we define it, and do that price stability. It's the Treasury Secretary's job, not the Federal Reserve's job.
All right, Bloomberg Opinion's Jonathan Levin joins us now with more. Jonathan, the effect that Treasury Secretary Scott Bessent wanted to see, he got it, but it didn't last for very long, right? Yields have bounced right back, and they're higher across the curve today, even after he indicated that Treasury could increase the buybacks even more than the $4 billion first announced. Your read here is the White House is desperate?
Absolutely. Yeah. Let's be honest about what they're doing here. This is a plea for lower borrowing costs 3 months out from midterm elections. And it's not going to do anything. It's signaling, but really it's not even signaling to the market. It's signaling to the voters because they're not going to get anything across in this market. You know, we're talking about a Treasury market that's more than $30 trillion. $32 billion in buybacks per quarter is not going to move things around here. And as you alluded to, and also as Mary Daly alluded to, this is a global phenomenon going on in the long end of the curve, right? There's a sea change going on over in Japan, which is experiencing real inflation for the first time in a quarter century or so. Central banks around the world are pulling back support from their balance sheets, and so big things are happening around the world. And in the areas where the Treasury could actually be doing something, like, say, these 6% deficits, which have become persistent, they're not actually doing anything. So this is a desperate attempt to sort of throw their hands up and say, we're trying here, we're trying, but it's not going to work, Scarlett.
All right, yeah, the federal deficit at 6% of the economy, whereas I believe Bessent said he wanted it to be at 3%. You also make the point that Scott Bessent is trying to time the market. How risky is that?
Yeah, extraordinarily risky. I mean, it's not the mandate of Treasury to make bets on whether or not rates are going to be lower in, 3 months, 6 months, a year, 3 years. In fact, Scott Bessent viciously criticized his predecessor, Janet Yellen, for supposedly doing the same thing with the way she managed the issuance calendar, for the way that she leaned into bills. He is now doing the exact same thing and more, becoming, one of the most interventionist Treasury secretaries on recent memory. So, really a shocking move, and working at cross purposes with, what, say, the Federal Reserve would like to see here.
And the other thing that you point out is that under Bessent's leadership, the Treasury has thrown a bunch of things at the wall to try to get the 10-year yield down, because that is their focus. How unconventional have some of these moves been versus, the expected things that Treasury can kind of pull out of their hat?
Yeah, extraordinarily unconventional. And again, I think it's so much about optics, because you can point to every single one of these things, and if they move yields at all, if they move the bottom line at all, it's for an afternoon and then it's gone. That's what we saw with this move today. That's what we saw when the Treasury stepped in and aided Japan with their yen intervention. The real story there was obviously that they were concerned about a major holder of treasuries potentially dumping those treasuries to fund their intervention. We could talk about the Genius Act and what that was supposed to accomplish. We can talk about bank capital requirements. All of these things were supposedly speaking to Scott Bessent's goal of lower 10-year yields. And guess what? They're not moving the needle.
It's not working right now. All right, Jonathan Levin, Bloomberg opinion columnist, joining us. Thank you so much, and be sure to check out John's work on the Bloomberg terminal. So let's dig into all of this with our roundtable. Lyngen is head of U.S. rate strategy at BMO, and Stephanie Roth is chief economist at Wolfe Research. So, Ian, let me start with you. Given that the drop in yields was fairly fleeting, we've seen them come right back, the round trip, do we presume that this increased buyback announcement is the start of something more, that this could be like a new regime?
Well, if it's not the start of something more, then we're simply going to see longer dated yields drift higher. Now, there's a conversation to be had about whether or not the size of 20 and 30-year auctions are too large in this environment. Not necessarily our call, but I wouldn't be surprised to see that idea get a little bit of traction after Bessent's move this week, simply because, as Jonathan pointed out, we're seeing a lot of non-conventional tools used to address this problem. And at the end of the day, it is a fundamental problem. It is a global issuance problem, and it's become an elevated real 30-year problem, which I think adds an interesting nuance at this point.
Stephanie, what do you think?
I think the fundamental issues have to be addressed to some extent, right? Like, of course, the Treasury could try to step in and address some of the supply-demand issues, but the problem realistically is a Fed that we don't really understand the reaction function, the data which have been hot. Our expectation is that you'll see the dynamics actually change from an economic perspective into the future, and therefore you actually get a little bit of relief from Treasury yields, but it's not really Treasury's issue to solve. So our expectation is that, certainly yesterday the move was too big. Now markets have certainly reversed that. We don't think there's a whole lot that Bessent can really do. It's really a matter of some of the other drivers that have to change in order for rates to come down.
So you talk about some of the other drivers. U.S. public debt hitting a new milestone, $40 trillion. That includes both treasuries and so-called intragovernmental debt. The biggest contributors to this public debt is, of course, the entitlements, right? Medicare and Medicaid, so health care, Social Security, and, of course, interest expenses as well. I mean, these are huge numbers. It's a huge round number, but, Ian, not really a surprise given how unwilling both parties are to address some of the fundamental issues. At what point does this really start to matter for the bond market?
I think it really becomes an issue when we start to see debt to GDP really accelerate from here. Yes, I know it's high. Yes, I know the world is concerned about that 40 trillion worth of debt outstanding at the moment. But I'm going to become more concerned when and if the deficit doesn't go the direction that Besant seems to be implying that it will. If they can make some progress, if there is fundamental change that they can affect, I do think that the pressure will come off of the bond market at this point. But Stephanie, I think, is 100% correct insofar as saying it comes down to the data, it comes down to how the real economy performs. And right now, I'll argue that the market has the luxury of being worried about term premium and issuance because the underlying real economy appears strong enough.
Right, and that's something that Besant has said as well, the idea that maybe you can grow your way through this. Stephanie, debt to GDP is something that folks in the rates market are looking at very carefully. How does the U.S.'s debt to GDP compare to other countries? If every country has a rising debt to GDP ratio, is our situation that much worse necessarily?
Yeah, I mean, that's the thing, is it is a global problem, but that's what we're seeing in markets. It's also been a global rates problem. Is this going to be addressed in the near term? Probably not. And over short-term periods of time, generally speaking, it's economic fundamentals that really tend to drive where rates go. And that's why our expectation is eventually we'll revert back to fundamentals, but the economic data haven't necessarily supported that up until this point. Though I have to say, in the last couple of months, you have seen some softer data, and rates haven't really cared. And it's probably because rates are now focused on some of the other sort of longer-term structural problems. That said, if we end up with the unemployment rate actually starting to rise a little bit towards the back part of the year, if payrolls continue to look soft, if inflation runs closer to 2% on a monthly basis, then we might be in a very different position. So it's very possible come the fall, when markets start to focus a little bit more on the economic data, that rates can trade more accordingly to the fundamentals as opposed to some of these structural problems, which haven't necessarily changed dramatically. They are just a remaining problem for bond markets.
Right. They're just kind of an overarching problem that's been around for a while. Ian, how much of the volatility that we've seen might be chalked up to the fact that it's the middle of August and perhaps there's not a whole lot of participation and people react a little bit more than they would if it were, say, the fall and everyone's back at their desks?
So volatility has been increased. Price action is choppy. Liquidity isn't bad per se, but it certainly isn't what it might be if the desks had been fully staffed and the street was fully engaged at the moment. I will say, though, that Warsh's pushback against forward guidance has added a degree of volatility just in general across the market that is starting to manifest in different sectors, and I think that's part of what is going on with the long bond as well.
All right, Ian Lyngen, really appreciate it, head of U.S. rate strategy at BMO, and Stephanie Roth, chief economist at Wolfe Research. Still ahead on real yield, San Francisco Fed President Mary Daly tells Bloomberg that Fed policy is in a good place. We've got more on that next. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. San Francisco Fed President Mary Daly this morning spoke with Bloomberg Surveillance, signaling that monetary policy is in a good place.
I think policy's in a good place, but watching this 10 and 30 to see what we need to think about, what are the structural factors, it's giving us a signal about something. And I think one of the big signals is the AI demand.
President Daly, we'll get into AI demand, but I am curious about the reaction function. You said that the market seems to be understanding the Fed's reaction function. What is your reaction function in terms of incoming information that would make you think that an adjustment higher for rates would be required?
Well, last week I gave a speech where I talked about really there's many scenarios that could occur, but two seem very important for me at this point. One is the one that I would suggest is the modal outlook. My modal outlook is that, and also you saw in the minutes, it's a majority of the participants' modal outlook, that inflation is being driven up by a series of shocks, and those shocks will roll up, they'll roll down, they'll roll through, and as that dissipates, then inflation will return to target, in part because we have policy at a very slightly restrictive level. So there's that dynamic. But then there's the dynamic of maybe the fact that we have so many shocks coming at once and they're overlapping, they can have an independent compounding effect. That means that the total effect is greater than the sum of its parts. The conventional dynamics of shocks just aren't working like they were. I'm not seeing evidence of that right now, but I definitely think we should keep that in mind and watching. If that happens, we'd have an inflation problem that we would want to treat. with tighter policy. In the meantime, I was very supportive of the July hold and continue to look at the information that comes between now and the next meeting about whether any signs of that worrisome dynamic would be forming. And I haven't seen them yet. And the recent prints on both inflation and the labor market didn't really change that picture for me at this point.
There's been kind of a paradox forming right now where you've seen inflation above target for more than 5 years at the same time that the labor market seems to be kind of meh. I mean, it's okay, but people keep talking about low hire, low fire, and that kind of dynamic with real wages not keeping pace for the past 5 years will lead inflation to go lower. Why hasn't it, right? I mean, when does that relationship reassert itself?
Well, one of the things that is true is that we've had many periods in our history with, essentially, if you're thinking in economics terms, where the Phillips curve is very flat, and you just don't see the relationship between the labor market and price inflation. And it also kind of illustrates why the shocks have been a big component of overall inflation. The tariff shock, the oil price shock, and now the AI investment boom shock. And in all of those, you have to ask, what is the expectation of their duration? Are they spreading to other sectors than the ones that they directly affect? And what do we think they will do if they compound with each other? Will that make a difference or will it not? So I think that's what's really driving it.
That was Mary Daly speaking with Bloomberg Surveillance earlier today. Still ahead, our credit roundtable. We'll speak to Meghan Robson, head of U.S. credit strategy at BNP Paribas, and Milwood Hobbs, deputy CIO of strategic credit platform at Oaktree Capital. We're going to talk more credit next. This is Real Yield on Bloomberg.
I'm Norah Melinda. Let's take a look at your midday movers. First up, a rally in the bond market is losing steam as investors question whether the government's plan to bring down borrowing costs is just a temporary fix. Meanwhile, a jump in oil prices is also reigniting fears about inflation. And that's all putting pressure on the stock market as investors weigh the rate outlook and digest the latest corporate earnings. And speaking of earnings, we got results from another big box retailer, this time Walmart, heading for its worst day since 2022 after posting its slowest U.S. sales growth in 6 years. And finally, Moderna giving back some of yesterday's massive rally after the stock nearly tripled on promising late-stage results for its melanoma vaccine with Merck. Those are your midday movers. I'm Norah Melinda.
It's time for a moment of interest. Moody's is calling for the insurance industry watchdog to impose tougher treatment on private credit ratings. The amount of privately rated debt surging more than tenfold to $481 billion in 2025 from just $46 billion in 2018. Bloomberg's Silas Brown joins us now from London. So, Silas, Moody's says it is driven by this concern that private credit ratings can overstate credit quality. What does it cite as evidence?
So they cite a Columbia Business research report that came out. We reported on it a few months ago that basically said that there may be a case of understating credit risk among this proliferation of private letter ratings. And the use of private ratings has really gone up in parallel to the kind of boom in the asset class. And I think a lot of the ratings that are kind of like underpinning the boom in this like multi-trillion-dollar industry come from the smaller ratings firms outside of the big three, the KBRAs, the DBRSs, even smaller ones like Egan-Jones. And I think this is this is another intervention in the kind of broader debate.
Okay, so Moody's wants the insurance industry watchdog to encourage insurers to rely more on public ratings. And given that Moody's main business is evaluating and rating publicly traded debt rather than private credit debt, isn't Moody's basically just talking its book?
Yeah, I mean, I think you see this with any boom in an asset class, is that the people who benefit are there from the start. And I think Moody's and S&P and Fitch, they've been keeping busy rating the kind of broader, more traditional, much larger corporate bond markets, and so it's kind of opened up an opportunity for the smaller specialist firms to kind of like gain a pretty dominant position. I think that comes with a series of challenges. I think broadly, not just in ratings, people are concerned that the infrastructure that's supporting the private credit market hasn't grown as kind of sturdy as the market has grown. And so I think there's a clamour to kind of firm up valuations and firm up ratings and other kind of, I guess, broad parameters around the industry to make sure that the market grows kind of in a healthy way as opposed to a sort of insecure way.
And we pay attention to this Moody's recommendation to this particular watchdog because insurers are significant investors in private credit, especially in the last couple of years. Just how significant, Silas?
I think they're very significant, and they're becoming increasingly significant, actually. There's a sort of a few tectonic plates shifting. One of them is that private credit is just moving away from its traditional roots as effectively like a junk bond equivalent. I mean, moving away from just sort of direct lending, backing leverage buyouts, to these more esoteric asset classes. I mean, you see the data center boom. You know, a lot of that's been supported by private investment grade, but also like CFOs and other kind of more esoteric asset classes. And those are the asset classes that are most attractive to insurance money because they are investment grade and so they're sort of, I guess, more stable, often more longer dated as well. But I think they also need, crucially, ratings, and that's where this kind of whole debate around private ratings and public ratings is coming from.
And how is the industry watchdog responding, if at all?
Well, so this letter was in response to a proposed framework from the NAIC. I mean, the NAIC has for long acknowledged a kind of like issues and working out standards of, I guess, like standards of practice among private ratings, much like you get in, you know, what is conventional in public markets. You know, I don't know, two ratings firms on each asset, things like that. And so Moody's recommendations was in response to a white paper ahead of the NAIC meeting, which happened last week.
As much as Moody's is trying to protect its territory against these smaller ratings companies, you've also written a story about how the SEC is pushing back against Egan-Jones, one of those smaller ratings companies' efforts to re-enter the market for public debt, including government debt.
Yeah, and I mean, Egan-Jones, I mean, I've done a lot of stories on Egan-Jones, and I think, you could say that they were one of the chief beneficiaries of the boom of private credit. I mean, they sort of spotted it early and have kind of been rating huge amounts of assets every year with quite a small team of analysts. And yeah, I mean, look, Egan-Jones is its own, probably its own segment, but yeah.
Okay, Silas Brown, thank you so much. Silas Brown of Bloomberg News in London. Up next, we've got the auction block. Alphabet going down under for its latest bond offering and what's being called kangaroo bonds. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the auction block, where we highlight the major credit issuance so far this week. We start with high-grade U.S. sales, where we saw a bit of a summer slowdown so far this week, with $16 billion sold. We saw names like QTS, Bank of New York Mellon, and MetLife. When you look at August as a whole, issuance rose to a record with $152 billion sold. This month is typically slow because of the summer, but that has not been the case this year, thanks to sales tied to AI and other drivers. And speaking of AI, outside the U.S., Alphabet paying just under 7% to borrow in its debut Aussie dollar bond offering, its highest ever for a note. It continues a trend that is called kangaroo bonds, where foreign companies sell into the Australian market. All right, earlier this week, I spoke with Double Line's Jeff Sherman about the discrepancy between the bond market selling off and credit spreads remaining tight. Take a listen.
Whenever you start to hear this argument about, well, should I lend to Microsoft over 5 years or the U.S. government over 30? I think most investors choose that concept of lending to Microsoft over the next 5 years, as at least we know that there's some semblance of revenue relative to spending there. So I think what you're going to see is this continued competition in the bond market as we have more and more gross issuance. All markets have to fund this CapEx expansion at this stage, while the government is also running massive deficits as well. So it's a competitive bond market out there, and some of this may be just the rush to get in front of the U.S. government as well.
All right, let's dig into all of this with our credit roundtable. I'm pleased to welcome Milwood Hobbs, Deputy CIO of Strategic Credit at Oaktree Capital Management, and Meghan Robson, Head of U.S. Credit Strategy at BNP Paribas. And on this interplay between government debt and corporate credit, I want to start with the big news of the week, which is the U.S. Treasury's intervention and into the Treasury market, right? How is that intervention affecting credit, if at all? What kind of signal does it send, Meghan, at least when it comes to government willingness to step into the market?
I think we saw the signal a positive reaction initially in the Treasury market with the rally yesterday, but some of that has been undone and potentially not enough to really keep a handle on 30-year bond yields. So I think the reaction in credit so far to this sell-off in rates has been relatively muted. I think one thing we've noticed is that the correlation between treasuries and credit over the last couple weeks has turned positive. So higher treasury yields, a little bit wider credit spreads, but those moves have been small, and over a long time period, credit spreads very tight. So I think we're being driven more by some of the other tailwinds for now in credit, but of course the risk of a sell-off in Treasury is growing.
Yeah, that correlation is something I want to get to, Milwood. Hyperscalers are all issuing debt. There's going to be more to come. We know that. A lot of it is at the long end. Is that contributing to higher U.S. Treasury yields?
I actually don't think it's contributing to higher yields. What I do think is contributing potentially is just where are we on the macro? And so I think at some level we're sort of reevaluating. We've got war. We've got movement in spreads, we have volatility in the markets. And so at some level, we're just really assessing where we are in relation to the risk in the macro.
Okay, well, let's go back to supply here. And I'm going to re-request that chart that we showed earlier about all the activity in August. September, typically a big month, we know that. But I wonder what the pipeline looks like, Meghan, because you look at what we've seen in August, and it's been pretty incredible, right? Hitting a new investment-grade sales record so far. I wonder how much of it has been pulled forward by the activity we've already seen. People are very mindful of the fact that Anthropic and OpenAI are getting ready to go public, and they will likely follow SpaceX's lead and issue debt soon thereafter. What does the pipeline look like, Meghan?
So looking into September, what we see so far is a 200 billion or so pipeline, which would be more than August, but not a record-breaking number like we've seen in other months. And I think one factor is hyperscalers. We do think a secular trend of greater borrowing into 2027 is certainly expected, but our forecast for 2026 for the scalers and public issuance, we're pretty close to that, and we still think it's a reasonable number. So we have a 250 billion hyperscaler forecast for this year. We're at 220 billion, so we think we could get another deal, but sort of this deluge of supply we've seen over the last couple months from the scalers, we think could slow down, at least in public, giving way to some relief in September.
I wonder also, Milwood, if there's a rush to issue now before rates perhaps go even higher, because who knows what's going to happen in the coming weeks and months, especially before the midterm election, as well as perhaps a Federal Reserve rate hike down the road. Do you see that, or do you think that's a part of it?
Look, I think there's a roughly 10 trillion of capital that needs to be raised. Offsetting that is 10 trillion of economic productivity. So I think we're a little bit less focused on the immediate and more thinking about the long term. And I think rates, while they're moving, I think you've seen the performance in the public market of these hyperscalers core. We've had good earnings. And so there's decent momentum, and you want to issue into that momentum. You don't want to wait. So I think you're going to issue, and you're going to see continuing issues because of the capital need that we have out there.
And of course, the hyperscalers are issuing credit. They're investment grade, but there's plenty of tech companies that aren't and haven't been. Meghan, the CCC spread is the widest since going back to Liberation Day. And that speaks to the stress of weaker borrowers as rates stay kind of elevated and borrowers need to refinance as well. The original issuance was, 2021 when rates were super, super low. It's now 5 years out. What does the wall of refi look like? Just give us a sense of scale that we should be bracing for.
Yeah, so the refi maturity wall, we haven't been discussing it much this year. We've had a break from it, but it is approaching in 2028.
Yep.
And for lower quality CCC issuers, for example, they have to be forward looking. So we look for 15 to 18 months in advance that they would start to address those maturities. So from fourth quarter of this year, we'll start to see how some of that is addressed and if it can be refinanced. For us, the bigger story is not interest cost for these issuers, it's really the earnings picture. So earnings has been so resilient that even though borrowing costs are high, coverage still looks pretty good. So I think we're watching that earnings as a bigger risk, a drop in earnings versus taking on an incremental borrowing cost for now.
How are you thinking about that?
Yeah, look, actually, interest rates have come down. If SOFR peaked in the low 5%, it's down to like 3.7. So coverage levels have actually improved. I think Meghan's right that the macro could be one of the issues out there. But look, there's a maturity wall of 27 and 28. A lot of that is in smaller businesses in tech. And so while there's been some view that AI has sort of created this noise or around the software, I think it's really the fact that interest rates went from 0 to 5%. And TEVs on those businesses have dropped because in 21, 22, we weren't sure if we ever go back to work again. And so I think you have to sort of digest that. But the maturity wall in 13, 14 ended up not being an issue. So we could turn around and see that maturity wall get solved pretty easily.
But as Meghan said, you're going to start looking for these companies to come up with, how they're going to move forward at the end of this year. Are you, as someone who invests in private credit, offering them private solutions?
Of course. we think the market for private credit is actually pretty good right now. 24 and 25, the issue you had more capital than opportunities. And with the outflows in BDCs, which I think has been a news line this year, you're actually seeing a little bit more balance between the two. And risk is being actually better priced. And so we're being more judicious about deployment of capital. We think sponsors today are more focused on execution and deal certainty. And at Brookfield Oaktree, we're sort of wanting to be the provider of choice. And I think that is a focus of ours. And we think that the market for private credit is actually pretty good.
So let me just stay with you for a moment here. What opportunities do you see as attractive right now, Milwood? Which sectors, and we can go beyond software because of the moves that we've seen there, which is obviously more distressed than others. I mean, are you looking at, say, chemicals or healthcare?
So we tend to price risk. So we're open to all industries. I think what's interesting is because the software is not as interesting for some folks out there. The other sort of opportunities tend to be priced technically pretty tight because everyone is in those opportunities, whether industrial, business services, consumer. We've done some consumer deals recently that were actually pretty interesting. So I think there is a market out there, and I think there's an opportunity to deploy capital so long as you're focused on price and risk. It's so long as you're focused on really looking at the situation over a cycle.
Meghan, what do you think about the consumer side? Because retail sales fell unexpectedly last month. The retail earnings, Walmart's numbers, for instance, this morning show that consumers at the low end are not spending as much as we might have thought they would. So clearly that has implications for paper issued by consumer companies.
Exactly. I think we continue to see, it's been in vogue to talk about the K-shaped economy. We continue to see sort of the lower income cohorts struggle. We position within the consumer, we avoid areas more exposed to things like restaurants in the high yield space. In terms of issuance, a lot of those type of sectors exposed to lower income haven't been borrowing as much. So they are the more rate sensitive type of sectors. And it's one reason why spreads overall have remained pretty tight because the issuance has been very bifurcated between these new economy tech type of names versus the old economy.
And, I think about what else has been happening on the macro level. We had this intervention in the yen by the Treasury Department, and it's made it cheaper for foreign investors to hedge in their own currencies. So, Meghan, I'm curious, is this increasing demand for U.S. credit at all?
We haven't seen an increase yet. I think that it really depends on the region. So demand this year has been very strong out of Taiwan. They've seen inflows into their U.S. dollar insurance policies. Japan has been an area of a little bit of weakness. So I think just the instability in the currency and hedging costs are still relatively high. So I think that buyer base has more taken a back seat for now and sort of waiting to see more stability either in the JGBs or in the U.S. bond market. All
right. Well, as we wrap up our conversation, Milwood, I'm curious how you are getting ready for September. Once this quiet period kind of goes away and people are back at their desks, whether it's the flood of issuance that we can anticipate, any kind of rate hike from the Federal Reserve, the final weeks before the midterms, the volatility that we might be gearing up for. What are you getting ready for?
Look, I think the volatility, we like volatility, right? Because I think that it gives us an opportunity to price risk. And we, as you know, Brookfield Oaktree, we have sort of outperformed or out-originated during those periods of volatility. So volatility is actually a good thing for everyone, I think. But going into September, look, I think the consumer is pretty important. Higher interest rates further constrains cash flows. And I think the lower end consumer has not been that active for a while. Credit at banks is being sort of tightened. So we got to watch for that. We got to watch for banks and what they're going to do on the credit side for these consumers who are not necessarily have the free cash flow they used to have.
How about you, Meghan?
So into September, we like banks over corporates still, I think, in terms of positioning where you can kind of hide out in the belly of the curve versus avoiding some of the longer duration. I also think leveraged loans look attractive within the Lev-Fin space. We have a call for three rate hikes beginning December, and that should benefit the carry of loans versus fixed rate.
All right, good stuff. I want to thank both of you, Milwood Hobbs from Oaktree Capital and Meghan Robson from BNP Paribas. And if you can't get enough talk on credit, please check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get your podcasts. Still ahead on Real Yield, Texas's ban on financial firms that boycott fossil fuels has led to higher borrowing costs for the state. We're going to detail all that next in this week's Muni Moment. This is Real Yield on Bloomberg.
We're just about halfway through the trading day in New York. I'm Norah Mulinda. Let's take a look at your midday movers. First up, U.S. bond yields are back on the rise as investors question how long the government's efforts to lower borrowing costs can last. Higher oil prices are also adding another wrinkle by keeping inflation risks in focus. Those higher bond yields weighing on equities with major indexes firmly in the red, with big tech driving the Nasdaq 100 toward a fifth consecutive day of declines. Among the biggest laggards, Walmart having its worst day since 2022 after sales unexpectedly fell short, with growth slowing to its weakest pace in more than 6 years. And finally, Bitcoin is climbing alongside Coinbase and other crypto-linked stocks after President Trump urged Congress to pass digital asset legislation, giving the broader crypto market a boost. Those are your midday movers. I'm Norah Mulinda.
It's time for our Muni Moment. Borrowing costs for the state of Texas are higher than they are for California. The yield that investors demand on Texas bonds are, on average, 0.3 percentage points higher than the Golden State. That adds up to as much as $3 million annually for every $1 billion borrowed in Texas. Our next guest says that may very well be due to Texas's public policy. I'm pleased to say I'm joined by Bloomberg's editor-in-chief emeritus, Matt Winkler. Matt, always great to see you here. Tell us about the specific policies that Texas has in place that you suggest may be resulting in higher interest rates relative to California.
Great to be with you. 2021, the governor of Texas and the legislature in Texas passed what was known as SB 13, legislation that prohibited any financial institution from underwriting, insuring, participating in state and local government debt for Texas if they were part of this commitment to have zero emissions by 2050, known as the Net Zero Bank Alliance. And every bank you've heard of that's a major bank was part of this. And suddenly they were told, time's up in Texas because we don't agree with you. Now, what this is really about is known as ESG, okay? What is ESG? It is obviously dealing with climate change. It's dealing with governance, transparency, pretty much good things that people believe in, okay? Right down the line. But Texas said, no, none of that. So what happened? Suddenly, according to data compiled by Bloomberg, the spread, the difference in yield that Texas was borrowing compared to California expanded, increased dramatically. As you said, it's about 30 basis points, which would be 0.0 percentage point, which would be, as you said, $3 million for every billion borrowed. The Texas people in government said to Wall Street, if you abandoned all of that, we'll forgive you and let you continue underwriting bonds. And they did. Everybody left the Net Zero Banking Alliance. It's gone away. They stopped using ESG in their vocabulary, but the spread remains. And why is that? Well, one place in Texas where Elon Musk has his lithium refinery is burning up, literally, to the extent that it's now borrowing at rates of interest that it's never had before relative to Texas. Very, very expensive. And Corpus Christi is not, you know, a little town. It's more than 300,000. It's on the Gulf of Mexico. So it is a proxy for Texas dealing with climate.
So Corpus Christi recently got downgraded by Moody's. Did Moody's make a direct link between extreme weather, the legislation, higher borrowing costs. Did they draw that connection?
Pretty much, yes, because they said the way things are going, Corpus Christi is going to have a water shortage by 2027. And that is not a good sign for anyone with a factory like Elon Musk and his lithium refinery. So that Corpus Christi, if you like, is that example that says climate change is real, and that the Texas policy of antipathy to science, saying we don't believe in any of that, is going to be hazardous for investors. And that's why California, which is the opposite of Texas, California embraces ESG, is dealing with climate, and the demand for its securities was always high.
Yeah. And now we're seeing this show up in how taxpayers need to be on the hook for it as well. Matt, always a pleasure. Thank you so much. Matt Winkler is Bloomberg's editor-in-chief emeritus, and be sure to read Matt's full column on the Bloomberg terminal. Still ahead, we are about 1 week away from Jackson Hole, and it is the focus of our final thought. That is next. This is Real Yield on Bloomberg.
Anything that happens within a 24-hour period is noise. And I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market.
That was U.S. Treasury Secretary Scott Bessent speaking to reporters earlier. Investors will be factoring in his comments as they turn to Jackson Hole, which will kick off next week, with Fed Chair Kevin Warsh facing down a skeptical bond market. Bloomberg's Enda Curran joins us now from D.C. with our final thought. Enda, given what Treasury has just done, increasing its buybacks to try to bring down the 10-year yield, how does that complicate what Kevin Warsh's message will be to bond markets next week?
I think it is a complication. I mean, there's obviously a lot of play for the Fed right now, Scarlett. But on paper, if you have the Treasury intervening to buy bonds to bring down borrowing costs, that implies cheaper loans for households and mortgages at a time when inflation is where it's at, when the Fed is trying to control inflation. I mean, that would suggest the two are working against each other. Now, it may not necessarily play out like that because we've already seen this morning, for example, yields are back up to where they were before the Treasury announced its intervention. But it is a complication, and it does push against the line from new Fed Chairman Kevin Warsh that markets need to do their own homework, go and play the ball, not the referee. They should be sending signals to the Fed. Well, some of the feedback from Fed watchers this morning is, well, how can the markets send a signal to the Fed if the Treasury is trying to control where those yields are in the first place? So, it's not a game changer for the Fed. A lot depends on the duration and extent of this intervention, but it is a complication.
It is a complication, although having said that, the Fed may do less communicating as well. We learned from the minutes, we got some more details at least, that Kevin Warsh may reduce the number of policy meetings per year down to 6 from 8.
Yes, this was discussed at the last policy meeting. No decision has been taken on it yet. Now, again, there are two views on this. There are certainly plenty of supporters for the idea, Scarlett. They say that the cadence of the meetings isn't often very smart. They could meet perhaps at a time of month just before important inflation or employment data, for example. And that does happen. And there's also an argument that they don't necessarily need to meet 8 times a year anyway. The pushback against that is one of transparency, really. And this has not been changed since 1981. The schedule has settled on 8 meetings. You can argue about the timing and the cadence of those, but really and truly, it's good to have policymakers gathering for that minimum amount of time. But it does seem like change is on the table. It's a question of whether or not the rest of the policymakers will come and agree with Chairman Warsh's suggestion that it should be 6 instead of 8.
And just remind us, Enda, before we let you go, what day is Kevin Warsh speaking?
It's not public yet, Scarlett, but we expect it probably should be Friday morning at Jackson Hole.
All right. We'll be looking for that, and of course, for you to offer analysis as well. Enda Curran, thank you so much for joining us from Washington. From New York, that does it from us here on Bloomberg Real Yield. Join us at the same time, same place next week. You can see yields moving higher across the curve. The 30-year yield, 5.24%. It has unwound all of the moves that we had seen after the Treasury announced its increased buyback. Again, higher across the curve at the moment. This is Bloomberg.